Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in studios today for today's podcast. A whole bunch of news, a whole bunch of earnings, a whole bunch more information that we're actually going to be getting tomorrow morning as well regarding inflation. And we're going to talk about all this stuff today because there's a lot of volatility going on in the marketplace. And it's really just a question of are we as a market participant going to allow our emotions to dictate our decisions? That's a big reason why we do the podcast, a big reason why we do the show. A lot of the reasons why we get a lot of great feedback from customers is because they all watch the news just like we do here as, we got CNBC in the background here all day long, every day. And, I understand what the headline risks are. We're going to talk about all of them today. I'll give my thoughts on each one of these risks that we call a wall of worry that the market has to climb and overcome to get past all of this. And we'll provide some words of wisdom today. So the one thing the marketplace does from a media standpoint is they do hit on the headline things, but they do very little as far as context. Like, how many times have we done this or been through this in the past? What was the outcome? So I'm going to share some words of wisdom here from Warren Buffett today as well to hopefully, get your mind wrapped around this correctly, because I think that's the biggest problem. I mean, Buffett himself said the person that he would hire would be a person of great temperament, meaning that they can control their emotions under stressful circumstances like what we're dealing with here today, because that's way more valuable from an investment standpoint than hiring somebody with from the best colleges, let's say from the Harvards and the MITs of the world. That's all great, having that knowledge and maybe God-given ability to be super, smart and handle a lot of different variables of information at the same time. That's great. There's no discounting that at all. But if you can't control your emotions, it doesn't matter how well you do at quantifying a bunch of different variables. So we're going to spend some time talking about that today. And that's the crux of the reason why we do this podcast. And I think the viewers and listeners really benefit from it. We got a lot of good feedback from it so far.
Yeah, in a broader philosophical sense, that is one of the contributions Descartes left on humanity, which is it kind of boils down to his thing: the map is not the terrain, which means it doesn't matter how much you study going into the jungle until you actually get there and get boots on the ground experience. You don't know what it's like.
Mic drop. That's some wisdom right there.
Yeah. Obviously, he was coming at it from a little more of an armchair lens, like art and philosophy. But words of wisdom nonetheless. And it's awesome to see repeated in a more nuanced context by Buffett. Certainly someone who has gotten on their boots on the ground and knows what they're talking about.
Oh, for sure. I think it's not even a debate. Greatest investor of our generation. I don't even think it's close. There's a lot of good ones, that I've paid attention to and spent time studying, but I don't think anybody's done it as consistently for as long of a period of time and have, the types of outperformance relative to the S&P 500 than Warren Buffett himself. So I think the words of wisdom that we'll get to here today will hopefully provide some context about how to deal with your temperament and getting through this period of time. Because I do believe this is short-lived. Markets aren't supposed to go straight up in a line, but they do tend to come down in a straight line very, very quickly. So we're going to talk about all these things here today. But besides that, we got to do a quick pick on the World Series. Who you got?
Oh, man.
Rangers, D-backs?
I'm torn. I love the fact that the D-backs are in it just because of how long it's been. And parity in professional sports is something I love. I'm a huge fan of the Rangers manager, though, Bruce Bochy. That run he had, that 6 years with the Giants was, even though I grew up a Reds fan, I was rooting for the Giants the whole time because the Reds were terrible during that stretch.
Oh, yeah.
So I'd be awesome to see him take another team and win.
I love the state of Texas. Spent a lot of years down there. My family lived down there for a period of time. It was great. Love the state. Like I said, I could live there in a heartbeat, no doubt. It's hot.
It's hot for sure.
But I like the hotter weather, no doubt. But
same.
I like the no state taxes too, which is also cool. I am going to actually go with the D-backs, and I have no affiliation to the D-backs or any of the players or the manager or the state in which they play in or any of those things. And the reason why I'm going with them is I like the underdog narrative that they have.
Yeah.
And they're very, very similar to the Reds. Like nobody really thought that they were going to do what they've been able to do this year. One, make the playoffs because their roster is so young, just like the Reds, extremely young. But they not only made the playoffs, but now they're in the World Series. So because of that, the similarity that I see between the Diamondbacks roster and the Cincinnati Reds roster is why I'm going to go with them, because I think that there's hope.
Yeah,
right here.
If they can do it, we can do it.
That's it. So I wanted to get that out there. That's my historical, sports perspective here. So
yeah, but be honest with you, like I'm just going to have fun watching this one. It's so great that it's so great as a fan that none of the teams you thought were going to be in it are there. And like someone like out of left field, the D-backs is in it, Yeah. I think everybody kind of expected Texas to take a leap to being a contender this year, but I don't know about actually being in contention. You know what I'm saying? Those are two different things.
They had a squad though. Like I think people maybe a little bit surprised, but not nearly surprised as like the Diamondbacks, for example. I don't think they were even expecting to make the playoffs. So let's watch some baseball. This is it. You got 7 more games, and then I guess everybody gets to turn their attention to not just the NFL, but the NBA, which we'll get into. I know that's your jam, man.
That's my jam, man. I actually bought YouTube TV 48 hours ago just to spam the opening week.
Yeah. Well, this is a great time of the year because you got three major sports, and hockey, really 4.
Yeah.
Which I'm a fan of too. So anyway, let's get to the meat and potatoes. I'm going to start with earnings. We're right in the middle of earnings season. We got some stats here already. We're going to kick off the show with. So we got 120 companies reporting this week alone. We've had 133 reports so far. That's about 35% of the S&P 500, right? 79% of companies have beaten estimates, and they've beaten estimates by a median of 6%, which is really strong. Anything north of that 70 range is pretty dang good. No question about that. Now let's talk about some specific earnings though. All right. So I want to spend a little bit of time on this because obviously earnings matter, but earnings are a little bit of a hindsight metric, right? Because the earnings are from all the sales and activities from the prior quarter, which are important because there's estimates. Obviously, we're going to talk about the consensus or the market estimates for revenue, earnings per share, all that sort of stuff. So earnings matter as far as how you figure out, the value of a company, what their forward sales might look like, which could change the value one way or another. Earnings definitely do matter, but the earnings calls that they have with the CEO, CFO, also are very important because it's kind of giving you some insight into the quarter that we're in right now, which is Q4. We're pretty much a month into the quarter, so these calls that are happening right now after the earnings announcements are made are kind of giving analysts in the market some idea as to what this quarter that we're in right now, Q4, might look like.
Yeah,
and therefore, we get a potentially better picture of the value of shares of stock. So I'm going to give you some big ones here. Again, we've had a bunch of companies report this week, almost a third of the market reporting this week. But I'm going to talk about 3 specific earnings announcements. I'm going to start with Google, because this one to me doesn't make a lot of sense from a post-earnings reaction standpoint. Maybe some viewers out here, some difference of opinion, you can hit us up right on the YouTube live, leave comments, questions. You can text them in right now. I got the phone right here, 513-630-2664. So Google, obviously one of the, we'll call them part of the Magnificent Seven. Don't really like the term, but that's what people are giving it. So Google, or Alphabet, publicly traded. Revenue was expected to be $76 billion. It came in better than expectations, $76.69 billion. That's 11% rise in revenue year over year.
Wow.
Great. Earnings per share estimates were $1.46, came in at $1.58. So we beat on the top and bottom line. Generally speaking, that's all you really want to know from an earnings standpoint as an investor in these shares, which we are. We have this for pretty much every customer, probably all customers, I'd say. So that was great. Initially, stock price popped, and it was awesome. Let's dig into how they got the revenue and earnings per share, though. So ad revenue. A lot of people were concerned about ad revenue because if you think about it, like last year, 2022, we couldn't call it a recession year because unemployment was under 4%. But to me, that was textbook recession in all metrics except for the unemployment. You saw 2 consecutive quarters of negative GDP. S&P was down 20%. The only box that did not get checked, like I said, was unemployment. So ad spend goes away, right? If you're going through a recession or a stressful economic activity, it's very easy for company CEOs to say, yeah, man, we're going to spend less on ads, this quarter of marketing our products and services because we got to tighten the belt. It makes a lot of sense. And if you're a company like a Google, Meta, Facebook, and Amazon, I mean, that's where the majority of the ad dollars are going to go to, right? Because they have the data to target consumers to get the right product, the right service in front of the right person at the right time, and maybe even putting something in front of them that didn't even know that they wanted or needed. I mean, that's really what Amazon's done a great job of. So ad revenue is extremely important to me in these earnings announcements because it gives you some indication as to whether or not corporate America CEOs are seeing a recession coming down, the pipe. Ad revenue for Alphabet, Google, expectations were for $59.6 billion. It came right in line, $59.6 billion. That's great. Did not miss. Very important. So YouTube, switching over to that, YouTube, which is what we're on right now. Love YouTube.
Love it.
Revenue was expected $7.8 billion, came in at $8 billion. So we beat on the top and bottom line. We met expectations on an ad revenue spend.
Yeah.
YouTube beat expectations. Now let's shift gears to cloud, Google Cloud revenue, right? Which is part of their AI piece of the business, if you will. If you're going to do AI, got to shift to cloud, etc. Economists or analysts were expecting $8.6 billion in Google Cloud revenue sales. Google actually reported $8.4 billion, so obviously a slight miss here. However, Google Cloud revenue was up 22% for the quarter. It was previously in the prior quarter up 28%. So I can see a difference there. Clearly, anybody can see that. But does that slight miss on that one segment of the business, now that Google has diversified their business, right? We just talked about three things. They do a lot of other stuff too to generate this kind of revenue, recurring revenue on a quarterly basis and on an annual basis. Buffett calls this a mode of safety. So when a business can diversify themselves and actually generate pockets of revenue in different areas of the economy, that they're building a moat around the business, if you will. And the bigger the moat, the higher the walls, the safer that one would feel.
I like that analogy. Yeah.
Right?
Yeah.
So that's why that mode of safety term, that's where it comes from, right? Going back.
Mode of safety. Okay.
Yeah.
Gotcha.
Literally think about Viking days, right? And you're in Great Britain, right? You got your big moat, your high walls, and you got all these different resources to protect yourself.
Right.
Generally, you would feel safe.
Yeah.
Right? Not to say the Vikings can't take over, completely different podcast.
They kicked Britain's butt.
They did. Sometimes they lost though. But that's where that mode of safety term comes from, right? The business is diversifying themselves. Therefore, they're more insulated and protected from macro events. Got that? All right. However, because they missed on one segment, the stock price drops 9%. It's actually down 11% post earnings, which essentially wiped away all the gains from the prior quarter. And looks like maybe then some right now, give or take, as I'm giving this podcast to everyone. So basically what the market is telling me, the market being other investors investing in Google that have now decided to sell the shares of Google, right? Because if you're selling, if the stock price is down 11%, there's more sellers than buyers of Google stock in this moment in time.
Yeah.
It's based on this news.
Right.
So you're telling me that the market is going to go ahead and value the shares of Google really based on one thing. It's kind of like you forgot about all these other segments of the business that they're generating record profits from that allowed them to outperform on the top and bottom line. I would give them a little bit of grace and applaud the ability to say, hey guys, you grew cloud revenue by 22%. That's great. I know it wasn't quite as good as we were hoping for. Maybe not quite as good as the prior quarter, but great news is you guys have other awesome businesses that actually allows you to outperform estimates, which is, last time I checked, the way that things are valued is based on estimates of what corporate profits and revenue are going to be.
Yeah.
So I don't have a really good explanation as to why this happened with Google shares, other than to say that I think the average investor, the only thing on their brain as it relates to these tech companies is AI. And if AI isn't what I thought it was going to be in your corporate earnings announcements, then your company sucks. I don't have a better answer for it than that, because nothing else.
I mean, Google is.
Where are they going?
With AI though, like they're kind of at the top of the tier. So who would think that Google would suck at AI?
It wasn't as robust as the prior quarter, or what analysts expect for that one segment of the business. And that's why I'm delivering this message to people. Is I truly think we're going to get to the words of wisdom from Buffett here, but I just think people are too wrapped up in one thing, being AI, as opposed to saying, that's great. This component's obviously generating profits and revenue, and you can see that there's a future growth rate for that. By the way, investors are supposed to be looking 6, 9, 12 months down the line and projecting what these companies might be worth based on sales and revenue and earnings.
Yeah, and maybe still, we've talked about this in the past, a little bit of misunderstanding of what AI actually is by the average investor, maybe even more professional investors. Because I mean, if it weren't for Google, we wouldn't even know what AI is, and we wouldn't even have a context for it as a generative software, right? I mean, basically Genius software in Apple and search engines optimized by Google are how we got to having AI so prolific, so ubiquitous as it is now.
Yeah.
So maybe folks are just like, oh, you didn't say the magic 2-letter word of AI is now powering this, but Google is AI. Like their whole thing is AI.
Right. You're 100% right. All these companies, Amazon's actually giving their earnings announcements tonight. Clearly we're a shareholder, and if they don't hit every little metric out of the park, it's difficult to watch the earnings based on what you saw here with Google. But let me compare that real quick, because the same day that we got the Google earnings announcements, we also got Microsoft. Microsoft is considered right behind NVIDIA as the top beneficiary of artificial intelligence technology, given their embedded base of customers with Microsoft 365. Right?
Right on.
So here we go. Microsoft. Revenue was expected to come in at $54.5 billion. They beat that, 56.5. So they beat by $2 billion in the quarter. That's obviously great. Its revenue's up 13% year over year. Earnings per share expected to be $2.65. It came in at $2.99. So they smoked top line and bottom line revenue. So let's get right to the cloud part, right? I just talked about.
Let's do it.
Google smoked all their stuff too, but the stock price didn't perform like Microsoft's post earnings. So Microsoft was up 4 or 5% post earnings. Actually, probably has come down now. I have to check it as we're talking here, just because it's getting sold off and bunched in with all these other big cap tech companies. But the cloud revenue, so Azure, right? That is Microsoft's AI play. Obviously, a huge component of their growth and part of the Microsoft ecosystem of the business. It's not the only thing that they do. They do all kinds of stuff as well. You know, products like this, Surface Pro. They have Microsoft 365 software. They are acquiring Activision Blizzard. Like, we can go on and on about the business, but I'm just going to give you the cloud revenue, right? Because they smoked all those metrics too with Microsoft, just like Google did. But cloud, Azure was expected to produce it was expected to grow 24%. It grew like 28% during the quarter, so they beat that, and they actually had $31.8 billion worth of revenue coming right from their cloud source, Azure. So they actually beat where Google did not beat on their cloud revenue, and that's what sent the stock price up. So again, I don't think any one company that's as diverse. So I'll give you a simple example. Zoom. We use Zoom here, Shepherd Wealth Management. That way we can interact with customers conveniently when we're traveling or they're traveling, or they're just too busy with work and life in general. So it's a great product.
Yeah.
Zoom doesn't do anything other than allow me to talk to somebody virtually.
Right.
I can't think of any other part of the business that makes them profitable or gives them profits, right? They don't have a robust cloud division. They don't have a YouTube. They don't have other moats to bring in revenue. Okay.
Yeah.
So you're telling me these big cap technology companies that have this huge moat of safety, fortress balance sheet of cash. We're talking about cash piles. They're actually making them money now because cash is paying out 5% right now based on money markets. Whereas over the last 15 years, they were not giving you any return as a shareholder for any cash piles because interest rates were zero. And I believe there was a statistic that Apple is basically bringing in $7 billion in annual revenue due to the interest that they receive on their cash pile before they sell a product.
Oh my.
So this is put into context, right? But individual investors, I'm watching it in the market right now, are pricing these companies based on really one thing, based on their cloud revenue, and or you can look at that like artificial intelligence prospects for future growth. And I don't know why people have this bar set so high in their mind that they're selling shares of these phenomenal companies with these wide moats of. I don't know where else you'd rather be. When I start to get into all the other risks that we're going to talk about today, where the hell else would you rather be? A company like, not to pick on Zoom, but it's just so simple to see the differences in the business model. Would you rather be in a Zoom type of company or Whirlpool, right? They make washers and dryers and refrigerators. Dishwashers. Yeah. It's not a very diverse business.
No.
Compared to these other players.
Of appliances.
We can go on and on. Yeti, right? Publicly traded company. They make stuff like this and coolers. Like how many people need a $500 cooler? You need them once, maybe. Right, if you're going to get one.
Yeah.
There's only so many of these cups you can have in your house, right? So it's not as nearly diverse of a business as all these other companies, but yet they're getting crushed if they miss on one area, and that's really has a lot to do with artificial intelligence. So it's fascinating to me. It's sad to see how knee-jerk the market actually is. But when we get to this wall of worry here in just a second, I'll nail that point home. And then we'll wrap it up here with Warren Buffett's words of wisdom for everybody. So last one, Meta. We got those announcements last night, otherwise known as Facebook, formerly known as Facebook. And profits were up 168% from a year ago. Wallstreet was looking for $33.5 billion. They delivered $34.2 billion. It's just an amazing quarter in and of itself. Wallstreet was looking for earnings per share of $3.61. They came in at $4.39. So just freaking crushed it. I can give you a whole bunch of other metrics as well. I mean, literally half of the global population is on their platform, Meta, which is why they do so well from an ad revenue standpoint. And the fact that this is a company that's been in business so long and it's collected so much data across the globe of consumers, they have a really good AI technology to put the right product in front of the right customer to allow these companies to advertise better, which, as I mentioned at the top of the show, your major ad revenue driving companies are always going to be the Metas because, again, half the planet's on their platform every single month. And you got Google and also Amazon, right? They have the data to do this artificial intelligence thing very well and a platform in which to make it happen successfully from a business model standpoint. But yet, the stock goes up 4 or 5% after the earnings announcement is available for everyone yesterday after the market closed right around 4:30. But the earnings call happens and the CFO essentially comes out and says, ad sales have been a little slower than what we thought they might be to start Q4. We're not even done with the first month of Q4. We still have multiple months to go. By the way, it's holiday season coming up. There's going to be some ad spend for holidays last time I checked. We got a presidential election year coming up. I'm pretty sure there's going to be a lot of ad spent on all these major platforms that we're talking about here. So why she said this, I don't know, because everything else about Meta's earnings call, they actually got right in line, slightly above consensus expectations for profits this quarter, slightly above or below expectations from a spend standpoint for 2024, this year of efficiency continuing, and they lost less money in the lab division, which is where they're really the only division of Meta Facebook that's losing money is, the lab division where they're doing the goggles and so forth.
Yeah.
They lost less money than,
whatever.
That's right. Oculus. They lost less money than what people thought. So across the board, hit a home run from an earnings standpoint, but yet the call goes in one direction. Ad spend might be, maybe, even though we're telling you that we're probably going to exceed consensus expectations from a profitability and revenue standpoint, might be a little slower due to geopolitical stuff, even though they admit that they have very little business in that part of the world, being in the Middle East there where the actual conflict is taking place. And the stock price sells off by 5%. I mean, it's fascinating. And like, this is the reason why I think it's fascinating that the study of behavioral finance exists, right? It's just a study. You can get a PhD in this topic at any major university. And it just explains how human beings make decisions under stressful circumstances as it relates to their money.
Yeah.
And what we know from that study is human beings feel losses twice as much as they feel good about making money. So when there's anything to worry about at all that's, quote, serious in the mind of the investor, fear seems to grip them and take over the decision-making process. And I think that's exactly what we're seeing here right now. It's not fun to live through, but when we get through all of our earnings season, and let's say we're still hanging out around 80% of companies beating consensus expectations by a median of 6% or better, or somewhere around that, and we don't happen to have an issue with the Fed raising rates due to inflation rising, which we'll find out tomorrow morning at 8:30 when we get the core PCE number, which I'll talk about in a little bit more detail in a second. If that number comes in lighter than consensus expects, now you got like 4 or 5 straight months of the core number of inflation falling towards that 2% target. There is no change, by the way, in expectations for November rate hike from the Fed when they meet on November 1st. And right now, December expectations for a rate hike have fallen from about 28% to 25%. So what's the real change? What is this wall of worry that investors are dealing with here? And by the way, the NASDAQ, before we get to this wall of worry, the tech sector, which has dominated performance year to date, the NASDAQ is in correction territory right now. It's down 10% from its July high. And there was this study for Bank of America. This is the fund manager survey. So Bank of America, obviously a huge bank. They have fund managers. Bank has their own funds. And they're asking these professional investors, these fund managers, what is the most likely outcome in the next 12 months regarding a hard landing or not? So expectations jumped 50% from last month to this month. And let's see here. I got to put the bifocals on for this one. As consensus in the soft landing camp dropped from 74% to 64%. A hard landing jumped. September was 20%. Now in October, it's 30%.
What?
So these are the investors. What has really changed? In my view, nothing.
Yeah.
Right. You got this conflict over in Israel, which, by the way, I've gotten this question so much, I feel like I just got to get it out real quick.
Okay.
Investors are talking about, what is your take on the war over in Israel? My take is this. Might sound too simplistic for some ears to hear, but the truth of the matter is, as long as human beings have been on this planet, we've been in conflict with one another somewhere on the globe. I only say that not to be simplistic or flippant. It's not only the truth, but the point is you cannot diversify out around geopolitical risk.
Right.
It exists. It will always exist every moment and every second that we're alive and waking up that morning. So you cannot diversify around that. You could decide not to participate. That doesn't mean there's not conflict going on somewhere. And by the way, when we get to the words of wisdom here, you'd be very disappointed if you decided to not participate in a market. And if you're going to bet that the world's going to end, yeah, I agree that it'll happen, but it's going to happen exactly one time. And if you invest that way and you're right, who the hell are you going to collect from?
Yeah, there's going to be no money regardless.
Exactly. So let's get to this wall of worry here that the market's still trying to overcome. Starting with the U.S. 10-year Treasury yield. So obviously interest rates, when we talk about Treasury yields, these are guaranteed rates of return. This is what we call the risk-free rate.
Okay.
Right now, the U.S. 10-year at the end of July was about 4.2%. As we're delivering this to you right now, it's at 4.9%. So it's a pretty big move from the end of July from an interest rate standpoint. Obviously, that's going to put pressure on equities, but it's not as high as it was. We got over 5% on the 10-year not that long ago. So that hasn't really changed all that much. I think that number will change tomorrow morning when we get the core PCE number. Again, if that comes in below consensus expectations, you need to be looking at the 10-year at 4.6 or lower. If it falls below 4.6, which is where it was clearly before the end of July, then I think we're off to the races for a nice year in rally. So that's very key to me. I'd say of all the things that I'm going to talk about here, that's the one thing where you can look at and make a pretty strong statement that we're either going to have a great rally or not, depending on how the news comes out tomorrow morning with the core PCE, the Fed's favorite measure of inflation. Let's talk about oil. Oil prices in the July, $81. Now we're at $85. There's a fear. That's not that big of a move. 81 to 85. We've been above 90 for extended period of time this year. We were there last year. People are worried that oil per barrel will go up to $100 or greater just due to the conflict that's going on over in Israel, which I can understand that. There's some historical precedent for that. Last time Israel had an issue with, I think it was Iran. They decided to blow up some oil fields, and that kind of stopped a lot of the conflict there. So there's something historically to that. Of course, the war itself, people are worried. If you check out the Google searches for World War III, it's at its highest that's ever been in the history of data. So there's that fear that's out there based on Google search data. And of course, we talked about the statistics of the hard landing that jumped from last month to this month. The VIX, the volatility index, it was at 13.7 in July. It's now greater than 20, which is basically telling you that people are extremely fearful about future events.
Yeah.
And then lastly, you get this thing called negative price momentum. So the trend since the end of July, where the market peaked a little over 4,600 on the S&P, is down about 9%. So the trend has been lower, and it's definitely on the bulls, people like myself that see a year-end rally, to prove themselves essentially, because the data so far, to me, is no different than what it was the prior quarter when we had a all-time high on the S&P at the end of July. So here we are. What is the outlook for me? Again, we cannot diversify around geopolitical risk. We talked about that. The 10-year, yes, I understand that is a headwind for equities in the short run, but history would say the biggest expansion of PE multiples, meaning growth in the marketplace, happened when the 10-year was hanging out between 3.5% and 5.5%. We're still there.
Yeah. So
from a historical perspective, that's not that big of a headwind long term. It moved fast. That was the short-term headwind, going from 4.2 to 4.9. That's a lot of movement in a short period of time for the bond market. So the movement is, to me, the major reason why we saw equities fall post-July, August, September. But here we are in October with earnings season. And again, we just talked about how earnings have been really, really good. So what is the major risk in the market? Because it's not the price of oil right now. You might have a fear for what that might be based on geopolitics. But again, you cannot diversify around that. You and I don't control the price of oil. That's based on supply and demand. And we all know who has the majority of the supply.
Yeah.
So what is the major risk? It's still inflation. None of this stuff has changed. This is blowing my mind a little bit here today. I can't quite put my finger on why the hysteria that people have, given all the things that we just laid out here that are truth, factual, and relevant, just like a couple days ago kind of data. Mm-hmm. To me, the real risk is still interest rates and the inflation. So if we get a core PCE number, let me give you what the consensus is looking for tomorrow morning. Let's see, core PCE consensus is looking for 0.3. If we come in at 0.2 or lower, I think you're going to see the 10-year fall. Equities rally very, very nicely. And that's really the Super Bowl for tomorrow from a data standpoint. We get the University of Michigan consumer sentiment survey as well. But that's the major risk in the market. You get that to come in lighter than consensus thinks. I think the probabilities of the December hike continue to fall, interest rates fall, market rallies, and yeah, you're still going to have a potential issue with oil, right? If this actually escalates in Israel to a bigger degree, of course that risk is still there. Again, you cannot diversify around it, and you do not want to not participate in it. You want to be smart about the asset allocation, and that's something that we've been talking about with clients this entire quarter is rebalancing, because we've had a hell of a year from a performance standpoint. The average customer of ours is beating the market by 8 to 10%, right? Some are beating by a lot more, some maybe not quite as much depending on their age and risk tolerance. But we're beating the market handily this year. And it's not because I'm some sort of super genius. It's because we spend so much time looking at history of the market. Again, the market is made up of human beings. Human beings are very predictable over long periods of time. We haven't changed all that much. And this short-term period of time that we've been talking about here is what makes the market not 100% efficient. So the market, if you go to school for finance, we'll talk about an efficient market theory, meaning that all securities are priced perfectly because everybody that participates in the market has access to all the same data all at the same time. That's a nice theory, but that's not reality, because we're human beings, we're hardwired with emotion like we talked about.
Yeah.
right? Behavioral finance tells us that we're not, in the short term, really great at processing stressful information. We make poor decisions in general. So that's not a great way to go about making money in the market. And the market is a great place to build wealth. It is a terrible place to get rich, right? You treat a market like a casino, you're going to get casino-like returns. Like you might be big for a second, but you might be in the red deep,
soon.
Very, very soon. All right. So this is the wall of worry that investors are trying to overcome right now. You're seeing it literally play out in individual corporate earnings announcements. So this is why getting some historical words of wisdom from the greatest investor of all time, Warren Buffett, in my view, is extremely important in controlling my temperament. So let me read from you a little section of a book called The Essays of Warren Buffett, Lessons for Corporate America. This is a 5th edition. Lawrence A. Cunningham wrote this. Obviously, Charlie Munger and Warren Buffett gave him the information to write this.
Well, let's make sure everybody at home has their jammies and a nice cup of cocoa because it's story time.
One word sums up our country's achievements: miraculous. From a standing start 240 years ago, a span of time less than triple my days on earth. Warren's an old guy. Americans have combined human ingenuity, a market system, a tide of talented and ambitious immigrants, and the rule of law to deliver abundance beyond any dreams of our forefathers. You need not be an economist to understand how well our system has worked. Just look around you. See the 75 million owner-occupied homes, the bountiful farmland, the 260 million vehicles, the hyper-productive factories, the great medical centers, the talented field universities, you name it, they all represent a net gain for Americans from the barren lands, primitive structures, and meager output of 1776. Starting from scratch, America has amassed wealth totaling $90 trillion. It's actually more than that now. It's true, of course, that American owners of homes, autos, and other assets have often borrowed heavily to finance their purchases. We're a nation of consumers. If any owner defaults, however, his or her asset does not pass or does not disappear or lose its usefulness. Rather, ownership customarily an American buyer, our nation's wealth remains intact. As Gertrude Stern put it, money is always there, but the pockets change. Now, above all, it's our market system, an economic traffic cop, ably directing capital, brains, and labor that has created Americans' abundance. In summary, America's economic achievements have led to staggering profits for stockholders. During the 20th century, the Dow Jones Industrial Average advanced from 66 to 11,497. Obviously, it's higher than that now. It's at 30-some thousand at the moment. At the time that this was written, back in 2015 was its latest update, that's a 17,320% capital gain return that was materially boosted by steadily increasing dividends. American business, and consequently a basket of stocks, is virtually certain to be worth far more in the years ahead. Innovation, productivity gains, entrepreneurial spirit, and an abundance of capital will see to that. Ever-present naysayers may prosper by marketing their gloomy forecast, but heaven help them if they act on the nonsense they peddle. Wow. That's some direct truth right there, man.
Yeah.
If you want to sit here and be gloomy, that for whatever reason, that makes people sound smarter, right? Because the reality is when people wake up on January 1st, I know that there are compliance people out there. Past performance is no guarantee of future results.
Sure. Yeah.
Investing involves risk, including risk of loss. So I got my little disclaimer out there. But you just heard it from the man himself.
Right.
If you look forward and you look backward at the American history over a long period of time, betting against America was a terrible bet to make. But just participating in the market would have led to a tremendous amount of wealth built over time. It might sound like you're a super smart person when you're talking about doom and gloom from a market perspective. And the only reason why I think people feel like they sound smart when they say all this negativity is because the market on January 1st, when you and I wake up on January 1 every year and we're market participants, there's almost a 70% chance that you're going to have more money at the end of that year than what you started with.
Yeah.
So I think that that's why people gravitate towards those that have this negative bias on the market, because we're humans, we're risk averse. We feel losses twice as much as we feel good about making money. So when we hear somebody say, oh, the sky's falling in the market, and this is the reason why you should not be invested in equities, and they maybe give out some data points that support their argument, they're generally wrong.
They are generally wrong. There's nothing intelligent or creative about run in fear for your lives.
Yeah.
And don't do something.
Well, those people
that may be right in certain contexts, but
yeah,
that's also not a sign of intelligence. It's like, hey, be afraid and don't do it.
Yeah. I mean, as a market participant, you are the house.
Yeah.
And it makes total sense too, because what's the market? It's made up of humans buying and selling, right? That's why the price changes.
Yeah.
But it's also made up of corporate America, which Buffett talks about right here. Now, if corporate America is the engine driving the global economy, which it is, that's not debatable. If you're a corporation, you don't have a heartbeat. You're an entity. You're planning for the future. You might have quarterly earnings to get through, right? But if your profits are growing, that means the market valuation is also going to grow. And by the way, if you're a corporate company and your profits aren't growing, you're not going to exist.
Yeah.
You're going to get acquired by somebody else.
That's the jungle, baby.
Yeah, that's the jungle. So it makes perfect sense that over the long run, as Buffett talks about here, markets will generate wealth for the average investor. You're just going to have to deal with these stressful circumstances that we just laid out right now. And by the way, all of the stuff that I just talked about has happened right here. This dude has been investing for 60 plus years.
He's been through it all.
There's been wars. There's been inflation. There's been
2008.
There's been 2008, the worst thing that's happened since 1929. There's been financial bank collapses. You name it. You name it. This dude has lived it, invested through it, and he's still buying today. So actually the news this morning was he bought additional shares of Occidental Petroleum and some other securities. And Oxy in particular is in the energy field, of course. He owns like 26% of that. I think he started out with less than 10% holdings. This has all happened within less than a year. Yeah. He's literally living out what he's been preaching to people for decades, getting close to a century because he's that freaking old, is that he's going to be greedy when others are fearful. You see fear abundantly. You got the best companies on the planet. If all this stuff is true, this wall of worry that we're dealing with, where the hell else would you want to put your money? Yeah. You would want to put it in a company like an Apple, which without doing a damn thing because they're so good at what they do and they have so much cash, they're literally creating $7 billion before they even go make anything. Yeah. Nuts. But yet those are the first things that people want to sell right now. It's driving me a little nuts, but because I understand history is the only reason why we're not panicking. Literally what we've done here for customers as of yesterday, I spent, several hours rebalancing accounts, taking from some areas that have made a little bit of money or been flat, and allocating those resources to two primary sectors that we've been heavily invested in all year long, industrials and tech. So I am trying to practice for my customers what has been preached by the greatest investor of our time that has lived through it all and has seen all this stuff happen with corporate America. Yes, there's always going to be a wall of worry to climb. There's always reasons to be fearful, but I'm here to tell you that the only way to control the temperament is to look at what history has to say about similar events and understand that there are going to be brighter days ahead. We've already had a year where the stock market's been great.
It's a bull.
It's still a short little period of time where we might be consolidating some of those gains because we're afraid, to me, of what the Fed's going to do with interest rates. That's the reason why interest rates got to where they got, more so than anything else. So this is why we do this show. This is why I enjoy having these conversations with investors and clients. But to me, this is just a whole bunch of individual people that are extremely fearful about what might happen, not what actually has happened or what will happen. So there you go. That's the show in a nutshell here today, Ez.
Well, they're operating on the dark side of the force. And as we know what Yoda says, it's quicker and cheaper to be scared than it is to actually embrace the light and inform yourself and make a decision for the future.
The force has been with Buffett. I'm trying to give you that same sort of stuff as well here. So I don't know if we got any questions as it relates to all that stuff.
We
were rattling
the
this off here.
viewership looks like has just been tethered to your every word as opposed to responding, which is great because we haven't gotten any comments that we have to hide.
Not that we would. At least not until we see them and they're like, oh man, we got to take this down.
Yeah. It's one thing to disagree with Joshua, you all. In fact, I think we would all here encourage a different perspective. Mm-hmm. It's another thing to call us names. Just be mean.
Yeah.
That's not cool.
Not to wrap us up here in this way, but initial jobless claims also came out today.
Oh, yeah. We need to talk about that.
Street was looking for 200,000 jobless claims. We had 210. So it actually went up by 10,000, which is bad news because there's more people not working, but it's not a lot more people. So I guess the market didn't appreciate that as much because the Fed wants more people not to work, right? So they can get inflation back down to 2%. Literally, you cannot take good news as good news. Like you get GDP 4.9% today. The market consensus was 4.7. That's great. That's celebrated almost every other time in history. The only reason why it's freaking not celebrated is because people are worried that the Fed's going to mess around with interest rates because the economy is that strong.
Yeah.
I understand the logic behind that. It gives them the ability to consider jerking around with rates one more time. First of all, they know that another 25 basis points isn't going to do a damn thing. They've also come out and said that the increase in the 10-year, as I just outlined here from 4.2 to 4.9, is like the Fed increasing interest rates anyway. It's kind of done the work for the Fed from a rate hike perspective. So if we get that inflation print tomorrow, the core PCE to come in below 0.3, I don't care if GDP was 5.9 instead of 4.9. I just don't see a reason for the Fed to increase interest rates in December. And if that's the case, again, I think you'll see a pretty strong market rally here. So I think that we should celebrate things like a good GDP number, a good jobs number, people not losing jobs. But right now, because of this wall of worry we've outlined here, up is down, black is white.
Dogs and cats living together.
It's weird, man. It's very weird. It's frustrating. I get why the individual average investor all by themselves is like, sell. Like it's just too much to process.
Yeah.
In one's mind. So the default would be.
But that's the game. You know, if you want to play it responsibly and play it how it should be played, which is to build your self equity for the future, then you've got to play it.
Yeah. When investing,
you can't just react.
Yeah. When investing, what is comfortable is rarely profitable.
Yeah. 100%.
Like if you come in and you're like, man, this is perfect time to invest. You got the Fed's not engaged. Corporate profits are great. There's no problems around the world. All the political people in office are getting like that. That's not real.
I mean, I'm going to bring up my favorite analogy that's going to make your hair light on fire. That was crypto, right? During the pandemic. Mm-hmm. It's easy when every coin that someone pulls out of their grandma's couch cushion goes up in value when it's not real.
Right.
But when that all inevitably collapses and you have to actually be an informed investor into things like Bitcoin and Ethereum.
Yeah.
Like people don't want to do it and they just admit they turn their back on it.
Yeah.
You know,
it's it's something else to watch here in live time here. I highly doubt, unless inflation perks up again in a big way, that the rest of the year is going to continue this slide downwards. I mean, we went almost straight up for 6 straight months. Not really, because you had bank failures in here, right? People kind of forgot about all that. But the market had a great 6-7 months. Last 3 months haven't been great at all. And I think a lot of that has to do with the fear of what the Fed's going to do with rates, because that's when rates move. So we got done with earnings season into July. August and September, really no data, no earnings at all. So there's nothing to worry about except for all the stuff that you're supposed to worry about. And then we get thrown a additional conflict over in Israel right here in this month. So I think all of that, on top of the fear of what the Fed's going to do with rates is really the problem. But I think once we get through tomorrow, things will turn around for the better here. So that's everything that we had to share. Hope you guys got something from this particular podcast. If you liked it, don't forget to subscribe. Leave us a comment. If you don't like it, let us know what you didn't like and why.
Leave a comment.
And if you just want to be a jerk, then go find somebody else to be a jerk with. There's a million other places to go on YouTube for that. But we do appreciate all the feedback and support. Don't forget to check out all of the shows that we've ever done. ShepherdWM.com takes you right to our YouTube page, takes you right to our Spotify page. And while you're on there, we've actually been posting Friday blogs almost every Friday. And we've also been posting our newsletter, which has just been exclusively for customers up until this year. So you can actually get access to all of our newsletters going back from January, where we talked about this being a double-digit performing type of year, at least an opportunity for that, and gave you guys a lot of historical evidence as to why we felt that way. And we'll continue to do that. So I'm here to help. This is why we do this stuff. I don't want to just keep it for myself or just keep it for clients. There's enough bad news out there, and I want to give you guys some historical precedents for it in as many ways and platforms that I possibly can. So I really appreciate it. Hope you guys have a great rest of your week, great Thursday, and we'll see you again in a couple weeks. Take care.